And away you go, Dennis.
Okay. Well, good morning, everybody, and welcome to the Kushner Report for September of 2022. And at the conclusion of the report this morning, you'll have an opportunity to participate in our question and answer session. And as you know, on the Q&A side, we don't record that. So we have a lot of folks from all over the country, from Wall Street, et cetera. And we just kind of keep that. So hopefully you'll be able to participate. So it's been almost 2 months since we've last gotten together, and a lot has changed in the economy in terms of everything around the world. So very interesting changes taking place today. And we've got a great program. And what I'm going to do there's some folks on that focus primarily on real estate. And I've got some good information on the commercial and the residential real estate market now and going forward over the next several months. Okay.
The agenda's up, Dennis.
I don't have it on here.
You don't see the agenda?
No. Okay, hold on for 1 second.
Well, I'm just going to do it again then.
Okay.
See it now?
All right. Yeah, perfect. Okay, great. Okay, so what we're going to do today, we're going to talk about key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news, and then what's ahead in 2022. And the remainder, we'll take a look today, as I said earlier, commercial and residential real estate outlook for 2022. So getting started, first of all, the commercial real estate activity has really slowed thus far this year, reflecting the persistently high inflation and rising interest rates. And despite really increasing odds of a recession, the Fed has made it abundantly clear that it will do what it has to do and take the necessary steps to drive down inflation. And accordingly, we'll see further deterioration in commercial real estate fundamentals is on the horizon. Hasn't happened yet, but it will be coming in the foreseeable future. But basically, despite rising interest rates with potential for more hikes in coming months, commercial real estate has been successful through 2022 at this point. Now, if we take a look, for example, at real properties, strip malls, and for example, in the densely populated residential areas are doing well, such as grocery stores, salons, fast casual restaurants, and other retail offerings. In-person services have really picked up, and it's been very strong performance, especially since we've gone through the whole time frame with the pandemic. Now, if you look at Class B and C malls, they continue to struggle. They may be, for example, candidates for adaptive reuse. Their locations and proximity to parking could be used in the development of market rate and affordable housing. Many of these malls, for example, if you look at a B mall, that's really a middle market mall, basically, but it's much older properties. When you get to the C-level malls, those are the ones that to be well over 30 years of age and require a lot of money to invest to upgrade those malls, and they tend to be in lower income areas. As I mentioned earlier, the interest rates, well, now we're here with the all-time high. Interest rates have really steadily increased, and the factor is potential interest rates will be considered by those that are making investments in real estate, whether they're individuals or whether they're corporations. Office properties, the war for talent includes new amenities. So the labor shortage persists across all vertical markets. And while the hybrid workplace is here to stay, on-site work can encourage collaboration as necessary for many occupations. So companies are hoping to entice new workers with office amenities like outdoor space, daycare and catering, etc. Although the best amenities vary from office to office, they still find it critical to grab top talent. There's still a lot of people sitting on the sidelines. The current vacancy rate right now across the board in the second quarter of this year was 12.3%, which is fairly high. And you may remember here that, previously standards used to have in the old days when Jim and I were working in the old days at Xerox and other places, you had a large office, you had a lot of space. Well, what's happening now is that space is being reduced substantially. In some cases, it's cubicles. When I worked for Deloitte, they had what they call hoteling. You'd go to another Deloitte office across the country, you'd call, and they'd reverse reserve space for you in one particular office, so they didn't have to add more offices for individuals. So they're really taking a better look at how to maximize utilization of space. Industrial properties may expand the reach, basically. Companies may opt to create single facilities for multiple business purposes. For example, such as having a shipping center, or maybe an office will have a showroom. So they're trying to look at how else they can use office space for. If you remember, I talked several months ago, the law firms, most of them have gotten rid of their law libraries. They'll have maybe a small area where they'll have critical books and components that they have to have. And what they'll do is use that space for maybe offices for other attorneys without having to expand their offices and move to other locations. And again, you may say that growth. Now, the industrial boom shows no sign of stopping. And key is, as e-commerce and demand for quick last-minute deliveries continues, so will the need for industrial properties to support that particular niche. Now, the interesting part. Now, what's happening with the residential real estate market? Well, although the housing market is slowing down, homes are not getting any cheaper anytime soon. And the home selling prices are beginning to reset across the country. And there are some markets which selling prices have declined substantially. Now, I'm not sure if Tom Gallagher's on board from the Bay Area, but homes up there to some degree have dropped between $100,000 and $250,000 in the selling price. As the market sells, selling prices are now being listed below price. So homes are staying on the market longer these days, and we're seeing a decline in multiple offers occurring across the country. But keep in mind, we're not in a housing recession at this point. Kathy, who may or may not be on the program today from Orange County, she's extremely successful. She's had properties where she's had 10 to 12 people making offers on a home and driving the price up substantially higher than the listing price that took place when the house was listed in the marketplace. But you know what? There's little question that the high-flying housing market is really coming in for a landing. And home sales and new home construction are among the most interest-sensitive parts of our economy. So housing also tends to get hammered by recessions, with potential home buyers pulling back as their employment and income status becomes less certain. But the demand for housing was one of the first things to be revised after the pandemic. You saw people beginning to move and get in line to sell and buy across the board. But there's simply an affordability gap taking place right now, and fewer would-be buyers are able to overcome this. So the sudden sharp rise in interest rates, and they're going to continue for the time being, is putting many people on the sidelines. And Kathy will tell you that she's had some people that had offers on homes, and they decided do you really want to live here? Do we really want to buy this place at this time? And the answer was no, and therefore they decided to pull out of that potential opportunity. But like I said earlier, we're back. So over the last 10 years, this is the first time in 10 years that we've seen a decline in selling prices across the board. So is it cooling down? Is it good or bad? What does this really mean? Well, as interest rates rise, many potential buyers are thinning out in the process, and thus buying competition will decline. In addition, sellers will have to adjust to the new strategies going forward. And again, the primary reason again is because we've seen interest rates increase, and then you get down to the point where can you afford that? So let's say someone's decided to buy a place for $900,000, and they find out they're only qualified by the bank or whoever they're dealing with for $750,000. They have to decide if they can either put more money down, or do they want to stay on hold right now, or do they want to find a place that they can afford at $750,000? So all of this is still up in the air. However, as buyer market contracts, the properties stay on the market a bit longer, but more options may be available. The buyers can explore inventories as they become available. And we're going to see more inventories coming online. But the prior bidding wars should decline with more inventory on the market with fewer prices. And again, prices should begin to decline going forward. And we've seen that for the first time in 10 years. And there's also a shift in the bidding process. In many cases, buyers are waiving contingencies to get things through in a more expeditious manner. So we'll see some of that. And there'll be some more creative financing taking place as well. On the seller impact, it's a changing market in which the sellers will have to adapt going forward. So the seller will not see the same dozens of buyers as we saw over the previous 12, 13 months. And your real estate agent is now going to have to work diligently on her commission or his commission in terms of pricing and finding out what the true values are of that property and working more diligently with such strategies as staging techniques and other marketing tools to be able to close deals going forward. The real question comes up in many people's minds is, well, what happens to some values? Well, many real estate experts believe that the home values are not likely to decline, but the rate of appreciation should slow down. And with the current real estate changing, we'll see a slight increase in inventory. But overall shortages on inventory, coupled with a large number of prospective buyers and inventories, should move a bit at a slower pace. It's not going to stop, it'll slow down a bit. And especially as we get into this time of year where people are now thinking about the holiday season and year-end closing and businesses. So it tends to slow down at this point. So that kind of gives you a thumbnail sketch of what's going on in the real estate market. And we're going to talk more about that when we get to Q&A. So now I'd like to take a look at the key economic indicators. We're going to look at the gross domestic product, inflation, unemployment at the federal and the California level, and then of course the price per barrel of oil, which everybody is concerned about. So the one thing we'll talk about here is that this morning I got something from back east, and this is very interesting. So if you look at the global GDP, all these asterisks means there's changes since we last met. And so GDP for this year is now forecasted to be down around 2.2% and then dropping to 1.5 next year. Now, here's what's interesting. Our GDP was projected at 1.9% this year and dropping to 1.7. And Chairman Powell the other day indicated that it's possible that we could see a 0.2 point growth this year and then it dropping down to 1.2 next year. And that's priced on interest rates and also where do we stand with recession? And we'll talk a little bit more further in the report. As you know, the CPI index on inflation, the last number we saw was 8.3, and it's hard to determine what's going to happen in September. Now, keep in mind, we only have 2 days left, today and tomorrow, Friday night at midnight, and the third quarter is done for 2022. We should get some indications on that maybe sometime in the middle, hopefully before we meet in October, to get an idea where we were for the first 9 months of the year. And again, the unemployment picture is changing. By the way, inflation next year, if everything holds tight, what they're doing with the rates, it could come down to 4.3%, but getting down to 2 and maybe 3, many economists believe that's not going to happen until the latter part of 24, even maybe going to 2025. Again, right now it's undetermined. We really don't know what the real impact is. Now, if you look at the unemployment picture on the national level, it's at 3.6 looking at toward the end of the year. And then if you look, for example, in California, if you can go back one more slide, Robert, we're looking at 4.4% for the US next year, and that is predicated on some point in time going into recession. And then, of course, we have California, in which we're looking at 4.4% this year and the same for next year. And that's what the employment picture looks like. I dropped the oil price down from 125 to 120, and I'll talk a little bit more, but again, that target by the OPEC and the other colleagues that produce oil outside the country is to drive that rate up to 120. And we'll see. And I'll tell you where we are now. And we're fairly behind in that area. Now, let's take a quick look at the global economy. As I said earlier, global economy now is projected GDP to go down both in 2022 and 2023. The European Central Bank, basically, economists have further looked at theirs, and their concern is that the United States will be going into a recession, and that should have an effect on them as well. If we look at the Central Bank of Europe, they raised interest rates 75 basis points. And again, the biggest concern they have right now is inflation remains too high in the respective areas, well above the target for an extended period of time. So over the next several meetings, we expect to see interest rates rise further to dampen demand and guard against the risk of a persistent upward trend in inflation expectations. So their economy is going to really struggle, perhaps worse than ours. Interesting here with the Chinese economy, if you go back a couple of years ago when we first started the program, their economy was growing somewhere between 8 and 10% a year. And again, it's based on the numbers that they provide out to other countries and to us. They're looking now this year, as their economy continues to decline, authorities really remain committed to COVID containment in China. Their policies are to keep an eye on COVID, and at the same time, they're seeing a deteriorating real estate market taking place. And their GDP has been revised since early this year. It's now looking more like 3% this year. Now, the big shock is economists are now projecting that the Chinese economy for 2023 could be down as low as 1.6%. And that is significant. And we'll have to wait and see how that plays. You know, other countries around the world, such as Switzerland, Norway, etc., all of them are tightening monetary policy. And the concern is here, the same thing in Latin America, we're seeing a tightening of policy. And that's really driving down their respective currencies. And again, inflation is still rising. We have a concern of 8.3 here. They're looking at in the European market space, Eurozone. Right now, it's running at 8.9%. So they're a lot worse off than we are. If you look at the other countries like Brazil, England, Australia, Canada, etc., all of these companies have one thing in common. Within the last couple of weeks, they've all raised interest rates by 75 basis points, and they will continue to do that until they feel they get a handle on inflation. Now, if we look at the domestic economy, the good news is our dollar continues to strengthen against all currencies, and we're stronger than the euro, which is great news. And we're seeing more of this taking place. Now, the US IPO market has plunged substantially, especially since the Ukraine war triggered a lot of volatility. So we're seeing now that global interest rates are forcing a lot of pullback by investors. Now, according to recent data in 2022, we're on track to have the worst US listings since 2009. IPOs raised $5 billion in the first 7 months of this year. You ready for this? 96% lower than a year ago. So it's really being put on hold now for companies deciding to go public because of stock values and everything else. The producer price index, the good news, it fell at 1/10 of a point in August, adjusted, and that's great to see that go down in terms of what people are paying before the products get to the store and Sid and I can go buy them. The home buyers are dialing back again because of affordability issues with a shaky economy. However, activity has fallen, but we're seeing more people buying more products like at Home Depot and Lowe's and everything else, doing a lot of work in their homes. So try going to Home Depot at 9 o'clock in the morning. You have to drive around to find a place to park. I mean, the places are booming. Now let's take a look at inflation. We've kind of been talking about. You know, I said last month inflation was at 8.3%. And again, it continues to go up. Now, the good news is for Sid and everybody else out of California, we saw a decline in gasoline prices over the last several months. Unfortunately, in California, it's going the other way. But that's had an effect in terms of moving forward when they do the new calculation for September. The trade exports, good news here, we saw an increase again. So that's taking place. We're seeing more products leaving the United States outside the country, which is good for us. The trade deficit, the good news is here, it fell $10.2 billion last month. This is the first time in months that the deficit has been below between the 80 and $90 billion range. So this is very good news for us, and we have to see that more. So we ran around 71 billion this month. We need to see that continue. Now, retail sales were up 0.3 of a point in August, but keep in mind, the little people go back to school, so they need supplies and clothing and everything else. So we had a pretty good month in the month of August. Now, I want to take a look at what I have here is I've got 2 slides for July and for August on the job market, for 1 on the national level and 2 on the state of California. So if we take a look at August, payrolls increased by 315,000 and unemployment increased to 3.7% from the 3.5 we saw in July. The reason is more people are now looking for jobs. They're going back to work. You can call it free money. A lot of that money is gone and they're trying to find jobs now. Now, if you look at the key vertical markets, business and professional service has been strong for the last two years. It's been great. We're seeing strong construction, health and education, and again, retail and manufacturing. Those are the key sectors that we want to see continue to grow. Now, then you look at the prior month. So like I said, the trend is going down now in terms of the hiring projections. So there was 528,000 jobs created in July. And again, the same characters were very successful in terms of health and education, business and professional, et cetera. So it's been very strong for the last 2 months. However, we've gone from 528 to 315. And probably by next week, I think a week from tomorrow, we should have the September employment picture as well. Now you look at California last month. We just saw a meager 9,800 jobs were created. And unemployment went up to 4.1% from 3.9%. And again, the biggest issue here is trying to find truck drivers and production of oil and distribution of oil across the board. The negative thing here to look at, which is not good, is construction, finance, information services, and manufacturing all were negative at job losses. And those are key sectors for the California economy. Now look at July, almost 85,000 jobs and everything was pretty good. Look how things have changed in 1 month. We're talking almost 10x. So, that's where the trend is right now. We see the decline. Now, one of the key banks here, and I won't mention who it is, their chief economist said that we're not in a recession because we continue to have solid employment. Well, I kind of disagree with that, but we'll see what happens going forward over the next several months. Now, interest rates, for example, as you know, they were up 75 basis points last month. And as Powell said, it will do whatever is necessary to drive down inflation. So right now they're looking at possibly the federal funds rate being somewhere around 4.6 sometime in 2023. The real key right now is if you want to get up to the 2%, which has always been our target, maybe 3, you're talking about sometime almost going into 2025. That's a long way to drive down the inflation as far as we can. We'll have to see how these things occur. Now, I can tell you one thing, Powell said this, you've got September, actually October, November, December, they're still looking at raising interest rates by another 125 basis points before we get to the end of the year, which means we're going to see interest continue to increase between now and the end of the year. Now, mortgage rates, interesting here, as you recall, late last year, maybe November, December, and early January, people were getting rates, for example, between 2.9 and the low 3s. Well, as of 3 days ago, the current average 30-year fixed mortgage is now at 6.43%. That's the average. And that's besides all the deals that can be made to drive that down. But that's kind of where we stand right now. Now, the manufacturing index is something that we really need to look at for the economy. It dropped down to 52.8% last month. But the critical factor is many, many months ago, we were at 49 and 48.5. When you're in the red like that, below the 50, which is the mainstream target, you find out that you're either in a recession or you're going into recession. So that's critical from that perspective. Factory orders fell again 1% last month, which is not good. Then we look at small business level. Well, the optimism level rose to 91.8. It's up from 89. Months and months ago, we were well over 100. 100 is the real target for the strength of the economy. You look at consumer confidence, that went up again, which is good news. It's running right now about 103.2, and that's up from 95.3 in July. So that's very good for our economy, how people are feeling about what's going on. And that changes from month to month. The crude oil price, which is very interesting, yesterday's crude oil, the West Texas Intermediate, which we measure, went out at $78.80. The same time frame in July, it was $101.62. So we've seen some good movement in that area, but we want to see that reflected in the price at the pumps. So in the case for Sid, he's jumping up and down because he's paying less than $3 for a gallon of oil. If we look at the housing market, basically, we saw a decline in permits overshadowed the rebound in starts. Housing starts jumped 12.2% last month, which is very good. New home sales, for example, were up about 3.2 in August. But as I said earlier, the prices on the selling price of homes fell for the first time in 10 years below the listed price. Now in LA County, we saw home prices drop 2.4% last month to an average around 820K, but that's almost 29% lower than August of 2021. Orange County, we saw a decrease of 1.6%, and that's almost 32% lower than August of 2021. And then finally in San Diego, where Lauren and myself and a lot of you live, we saw a decline of 1/10 of a point, but that was 21% lower than a year ago. So you can see the difference in the real estate market within 12 months of time. Existing home sales basically fell in the softer market 4/10 of a point in August, but sales were up by 19%. Actually, sales were 19% lower than they were in August of 2021 on existing properties. This is a real key indicator. As you know, the government no longer tracks productivity on a monthly basis. So that it's by quarter. Now, the last quarter had some really, what I consider pretty bad news. The non-farm sector labor productivity decreased by 4.6% in the second quarter. That's pretty bad. So, labor output was also down 2.1%. That's tracking production and all the levels of how people perform in corporations. That's not good in the marketplace. Those numbers have to go the other way. And we'll see what happens as we go forward with the economy over the next few months. Now, usually we've had good news in the area, what I call it company displacements. Usually I will not address companies, for example, unless it's something like 1,000 jobs or more. Well, you can see the changes that are going on right now. So for example, the following companies had excessive layoffs. We have a company called Shopify. They had layoffs and they frozen hiring. That's 1,000 jobs. Warner Brothers Discovery, 1,500. Robinhood, which is a brokerage firm, they've eliminated almost 3/4 of their workforce, 780 people. Oracle, 1,000, and they're talking about dropping another $1 billion in operating expenses to get to what their target is in profitability. And you know what that means? A lot of that's variable cost. You have Peloton, which is in bankruptcy. They laid off another 800 people. Wayfair, which is it's been around for years, 900. Ford Motor Company, another 3,000. Snap, 1,000. Home Point, for those in the mortgage business, they're the third largest wholesale lender in the country, 931. And then Credit Suisse, 5,000. The one thing that hit the marketplace bad last week was FedEx mentioned that right now they got a serious problem. They're laying off between 5,000 and 6,000 people, and they're going to close at least 90 locations around the country, in spite of going into the holiday season. It's their worst impact in 40 years. Now, what's interesting, I love this area called mergers and acquisitions. It's been busy deal flows for a couple of reasons. One, keep in mind the rates in the M&A pool are very, very low. So a lot of deals are being done with low interest rates. And the other thing is you're seeing a lot of consolidation. A lot of companies are having almost flat growth. So one way to grow your business is to sell off unprofitable lines of business, for example, or on the other side is buy somebody or merge with other companies to grow and expand organic growth. And that's what we're seeing taking place now. So Cargill and Continental Grain is acquiring Sanders for $5 billion. These are two of the world's biggest food conglomerates in the world, and they're merging the major chicken producing business. This is a huge deal. 3M, as I just mentioned a moment ago, they're spinning off their healthcare services for $8.6 billion. They want to focus on sharpening their focus on profitability. We look at Spirit, this has been going on for 12 months. Spirit has terminated their discussions with Frontier Airlines. There's still talk that JetBlue is still in consideration of that. Then you look at TD Group is accelerating its international investment banking growth. It's buying a New York-based Cowen Incorporated for $1.3 billion in an all-cash deal. Whirlpool, which is a great product line, they're buying a company, entered into a buying company called Emerson Electric Company to acquire. It's called Incinerator. It's the world's largest manufacturer of food waste disposers and instant hot water dispensers. And this is a $3 billion deal. Then we have Cox, the entertainment industry. Cox is acquiring the digital news site known for its to-the-point blurbs on politics, technology, and business. The company is called Axios, and it's worth $525 million. Then we have Vista Equity Partners. It's a global investment group, and they're planning to acquire an automated tax compliance software firm called Avera in an all-cash deal for $8.4 billion. That's something for you, Al, in the tax business. Then we have eBay, and they're still alive and they're still busy. So what they're doing is they've agreed to buy a Syracuse company called TG Player. It's a fast-growing company that has created an online marketplace for trading cards, sports cards, etc. And so that's a big deal on their part. You've got Hudson Pacific. It's a Los Angeles-based real estate company, is expanding to meet the growing demand, which is good news, for sound stage space. And that deal's worth $360 million. CVS is back in the marketplace. They want to expand what they're doing. And basically, they're buying a heavyweight company. They're buying a company for $8 billion called Signify. It's a provider of high technology services for home health and safety. So they're expanding their marketplace. And now let's take a look at what else is happening. Well, for those of you that have Geico in California, I'm sure you got the news. It's one of the largest property and casualty insurers in the state of California. And basically, they're closing all 38 offices and they're terminating all employment in California. And they're changing their practices, how you'll be served with either purchasing a policy or getting serviced. So that's going to be a radical change in the marketplace in California. As I said earlier, builders are pulling back amid housing market uncertainty. Remodeling, again, as I mentioned earlier, is huge. Can you imagine, Sid, we talked about almost a year ago, it was $1,000 for 1,000 board feet. Well, it's down now to 585. It's dropped 60%. So more lumber is coming on now. It's more abundant for people. In the semiconducting business, the United States Senate has approved a $280 billion subsidy to increase semiconductor and fund research, which we desperately need. Macy's, along with former Sears, if you will, were the bellwether companies that were really the anchors in the malls. And so Macy's is stepping up the process of leaving the malls to get smaller space and carry lower inventories. That's the plan. So now a lot of these malls are going to have to be reevaluated for further use. That's what the deal is with Macy's. And keep in mind, there's a company called Hudson Bay. I believe they're out of Canada. They're still looking at them as a possibility as an acquisition one day. Amazon, if you can believe this, and they didn't say how, with recession mounting and inflation and war in Ukraine and everything else, in the last month or so, they now have 100,000 fewer employees. So that's pretty interesting. Then you have, how many of you like strawberries? There's a firm in the Bay Area, up where Mark Karcher is. It's called Tortuga Ag Technology. They've come up with a new technology machine that picks strawberries. And they're automating the process, and these machines will run 24 hours a day during the day and at night. They'll require future, downsizing labor, but they'll have labor to work the machines, but they're going to be less of a demand for labor in that particular area. That's a major breakthrough in that industry. I mentioned Peloton. For those of you that buy sports equipment, they laid off another 800. The key is here, they're trying to survive. They're in bankruptcy, but they're increasing prices, if you will, on their e-bikes and their treadmills. Wells Fargo Bank, for those of you in the real estate, basically, they're shrinking its vast mortgage empire, which once basically turned 1 out of every 3 homes being sold with loans were from Wells Fargo Bank. So they decided to drive that whole process down. They were spending well over billions of dollars in that area. They want to move further away from that. Now, this is a great thing here. American Airlines is buying 20 jets from a company called Boom Supersonic. And the aircraft, you can believe this, Paul Federi, they're going to fly at a 1.7 Mach speed over water. So let me give you an example, Sid. In Miami to London, it takes well, the normal flight for there was almost 9 hours. Now they're talking about under 5 hours on these planes to get to London from Miami. Think about that. That's incredible. And those planes, we'll see when they come on board. Apple, as you know, has been hammered substantially for doing a lot of manufacturing in China. As you know, they've moved a lot of their products out, like their watches and their MacBooks. They're all being moved to Vietnam. And on Monday, which I'll talk about next month, they also noticed that the i14 phone will be made in the future with production, etc., in India. There'll be nothing being done in China. They're moving everything out of that area. Now, one thing I wasn't able to get my hands on, there was a survey done by Price Waterhouse within the last month or so, and they surveyed the 700 top executives and boards in the United States. And 52% of them have put a hold on hiring, they're freezing hiring. Furthermore, 48% of them have either dropped or reduced signing bonuses. And then many of these companies are already in the process of beginning layoffs starting in October. So that's a shift going on right now based on that survey. And Panasonic is building a $4 billion EV battery plant in Oklahoma. This is great news. It's going to create 8,000 jobs. And basically, you're looking at Honda and LG. They're building a $4.4 billion plant, place to be determined, but they'll create another 4,000 to 8,000 jobs as well. Bed Bath & Beyond is a great tradition, and they're still struggling financially. And they're going to close another 150 stores. They've got to cut about $250 million of expenses. And one of the things they used to do, they used to have some of their own products that were private labeled, like a Walmart, et cetera. They're going to get away from that because it's too costly and they're not generating enough margin on those products. And then finally, I guess Regal Theaters, for those that go to the movies all the time, like Sid does, they filed bankruptcy last month. They've secured a loan for financing of 1.94 billion. I understand, I believe it's something like $5 billion debt structure. We'll see whether these guys can survive. And then, as I mentioned earlier, FedEx, that's the drop the worst in 40 years, and they're closing 90 of their 2,200 stores across the country, and that's about 5,000 to 6,000 jobs. So there's a lot of stuff going on right now. So what I'd like to do is I'd like to open it up for Q&A.